Last week, the market dipped hard. I was buying, a lot of you watched. Same thing happened in April. And let's be real, we've all felt that pit in our stomach when the portfolio is red. It feels like pain. But understanding where the pain comes from changed everything for me. We've all heard the quote, buy when there's blood in the streets, but knowing that and doing it are two different things. Because what's actually stopping you isn't logic, it's psychology. It's fear, it's regret, it's everything your brain throws at you to protect you from perceived danger. This video breaks down the most well-documented behavioral financial research so you can finally understand why you freeze, why it's so hard to buy dips, and what the pros do differently. And this doesn't just apply to stocks. These patterns play out across bonds, crypto, ETF, everything. So if you're deploying capital in volatile markets, you should really watch this video. Let's break it down. Instead of just throwing several terms at you, I've grouped these into three core psychological traps that stop most investors from buying when it matters the most. The first cluster is fear-driven biases, which are all rooted in emotional pain avoidance. Losses feel roughly twice as painful as equivalent gains feel good. So when prices fall, your instinct is to protect, not pounce. This emotional asymmetry causes people to avoid high quality opportunities just to dodge imagined pain. And honestly, you can feel this in everyday life too. I've got this at casinos before. Even the small losses feel disproportionately bad. But when I have real conviction in a stock, that pain signal just doesn't hit the same. That's what allows me to act. The takeaway here is that fear isn't a signal, it's a reflex. Outperformance comes from overriding that reflex. The next here is myopic loss aversion. The more frequently you check your portfolio, the more likely you are to avoid risk. Short-term feedback amplifies short-term fear. Frequent monitoring increases the perceived volatility of your holding and pushes you towards conservative decisions at the worst times. Last week, after putting in my buy orders, I closed the laptop, rented a motorbike, and rode through the mountains of Vietnam. I had no charts, no news, just space, and it really worked. The takeaway here is to zoom out, because if you look at your investments less often, you'll make better long-term decisions. The third part here is regret aversion. We are wired to avoid the emotional pain of making a wrong choice. So doing nothing feels safer than buying and being wrong. The ironic thing of this is this mindset causes you to miss the rebounds and later regret the inaction more. And let's be honest, for many people, pain of not buying last week is going to be loud this week. That regret will hit differently. The takeaway here is that regrets cut both ways. Inaction can be just as painful as an action. The second cluster here is inaction and status bias. These biases keep you stuck and indecisive. When things get complicated, we default to doing nothing. The more uncertain the environment, the stronger the inertia. We mistake inaction for safety, when often it's just procrastination in disguise. Inaction inertia. When we miss the ideal entry, we tend to skip the next best one. That inaction creates a regret loop that compounds hesitation. We convince ourselves it's no longer worth acting, even when the opportunity is still solid. The fix for me, this cluster was solved by doing the work in advance. I build conviction in names I want to own. I form real opinions on industry trends, AI bubbles, fundamentals, stuff like that. And I sketch out buy zones ahead of time. So when the dip comes, I don't have to think, the decision has already been made for me. The takeaway here is you don't necessarily need to have perfect timing, you need a repeatable decision. The final and third cluster here is referent traps and social influence, which shape your decisions based on faulty external signals. Anchoring bias. We fixate on past prices, especially highs, and judge new prices against them. So a dip looks wrong, even if it's fundamentally justified. This messes with how we assess value, because our brains cling to arbitrary reference points. And also herding and social proof. When others panic or do nothing, we follow. It's human nature to assume the crowd knows something we don't. I find this one actually pretty hilarious. Everyone wants to buy Nvidia at $200 when the hype is peaking, but when it drops to 180, the hype seems to go. Same thinking with Bitcoin. Hype drives comfort, not logic. The takeaway here is if you always wait for consensus, you'll end up buying late and miss out on the upside. And I think it's really important just to say here, and if you lost sleep last week, if you refresh your portfolio 20 times, if you froze and then regretted it, there's a version of this game where you don't need to time anything. You just buy the index each month, you compound, you chill, pick your benchmark. You'll get 80 to 90% of the upside with 90% less stress. And you know, funnily enough, this beats most professional fund managers. I think you really need to think about stress-adjusted returns here. Instead of looking for stocks or watching financial YouTube, find a passion, something you love, something you're good at, and then figure out how to monetize. Once you do, take a portion of every paycheck and drop it into a low-cost ETF tracker and then forget about it. Anyway, let's zoom out. AI infrastructure spending is still vertical, government investment is still intensifying, global competition is still accelerating. If anything, I actually became more bullish on AI last week. I started researching whether this was a real bubble, just out of curiosity. And the deeper I went, the clearer it got. The US will stop at nothing to win this race. This is a government-backed capex boom. QE is just beginning again, and December rate cuts were confirmed on Friday. 85% chance now. Oh, and I watched this interview recently that really stuck with me. I've done a whole video on it on my channel. If you ignore the doomer tones, there's a core insight. Every major economy will need massive AI infrastructure to develop its own sovereign AI. This isn't a story, it's a strategy. Dips don't derail megatrends. Anyway, guys, that's all from me. Thank you so much for watching. If you froze last week, now you should know why, and now you should know how to fix those inputs. Feel free to comment and give your opinion on this below, and do subscribe if you've gotten this far in the video. Thank you so much.